The day you turn 65, the IRS changes how it treats you, and almost none of it is in your favor, unless you know exactly what shifted. Your tax code changes, your deductions change, your Medicare situation changes, your retirement account rules change. And if you do not adjust to every single one of these changes the moment they happen, you will spend your entire retirement overpaying on things the government already said you do not owe. Here are 10 things the IRS does the moment you turn 65, and what you need to do about each one. Number 1, your standard deduction goes up, but nobody tells you by how much. The moment you turn 65, the IRS gives you an additional standard deduction on top of the regular one. For a single person 65 or older in 2026, the extra amount is $2,000. For a married couple, where both spouses are 65 or older, that is $1,600 each, so $3,200 combined. That means a single senior gets a total standard deduction of $16,850 before the senior bonus deduction is even added. Most seniors have no idea this extra amount exists, and they are either filing with the wrong number or paying a preparer who applies it automatically without ever explaining what it is or why it matters. Number 2, the senior bonus deduction kicks in, and this one is brand new. Starting with the 2025 tax year, every person 65 or older gets an additional $4,000 deduction on top of everything else. For a married couple, both 65 or older, that is $8,000. This stacks on the regular standard deduction and the age-related extra deduction. A single senior can now shelter over $20,000 of income from federal tax. A married couple over 65 can shelter close to $36,000. For anyone whose total income is at or below those numbers, the federal tax bill is zero. And yet millions of people are still having money withheld from their checks every month. The senior bonus deduction is temporary and runs through 2028, so claim it every year while it exists. Number 3, the IRS starts watching your Social Security differently. Before 65, most people are still working, and Social Security is not in the picture. After 65, if you are collecting Social Security, the IRS calculates something called provisional income to determine how much of your benefit is taxable. If you are single and your provisional income is under $25,000, none of your Social Security is taxed. Between $25,000 and $34,000, up to 50% can be taxed. Above $34,000, up to 85%. Many seniors do not realize that their IRA withdrawals, their pension income, and even their tax-exempt bond interest all count toward provisional income. One withdrawal that pushes you over a threshold can suddenly make thousands of dollars of your Social Security taxable when it was not taxable the year before. Number 4, your health savings account becomes a trap. If you had a health savings account, also called an HSA, while you were working, the rules change completely at 65. The moment you enroll in any part of Medicare, your eligibility to contribute to an HSA ends. And here is the part nobody warns you about. If you delay Medicare enrollment past 65 and later apply for Social Security, your Medicare Part A is backdated by up to 6 months. Any HSA contributions you made during that backdated period are considered excess contributions, and the IRS charges you a 6% excise tax on them for every year they sit in the account. People who thought they were being smart by continuing to contribute to their HSA after 65 get hit with a penalty they never saw coming. Number 5, catch-up contributions change. If you are still working at 65 and contributing to a 401k, the IRS allows you to make catch-up contributions above the normal limit. In 2026, the standard catch-up is $8,000 on top of the regular $24,500 limit. But if you are between 60 and 63, there is a super catch-up of $11,250. After 63, it drops back to the regular $8,000. For IRA accounts, the catch-up contribution is $1,100. The window between 60 and 63 is the most valuable catch-up period the IRS offers, and most people blow right past it without maximizing their contributions during those years. Number 6. Required minimum distributions start creeping toward you. At 65, you do not have to take RMDs yet, but the clock is ticking. Under current law, your first required minimum distribution from a traditional IRA or 401k is due the year you turn 73. That sounds far away at 65, but here is why it matters now. The years between 65 and 73 are your conversion window. This is the period when your income is typically lower because you have stopped working, but RMDs have not started yet. It is the best time to convert traditional IRA money into a Roth IRA at a lower tax rate. Once RMDs begin, your income goes up, whether you want it to or not, and every dollar of that distribution is taxed as ordinary income. If you wait until 73 to think about this, the window has closed. Number 7. The IRS lets you make qualified charitable distributions starting at 70 and a half. This one does not kick in at 65, but you need to know about it now so you can plan for it. Once you are 70 and a half, you can send up to $108,000 per year directly from your IRA to a qualified charity. That money never shows up as taxable income. It counts toward your required minimum distribution, and it reduces your adjusted gross income, which affects everything from your Social Security taxation to your Medicare premiums to your eligibility for other deductions. If you give to your church or any charity and you have an IRA, this is the single most tax-efficient way to donate once you reach the age. Plan for it now at 65, so you are ready when the time comes. Number 8. Medicare premiums start coming out of your Social Security, and the IRS is watching the connection. When you enroll in Medicare at 65, your Part B premium is deducted directly from your Social Security check. In 2026, that base premium is $202.90 per month. But if your income is above $109,000 for a single filer, Medicare adds the IRMAA surcharge, which can increase your premium by $1,000 to nearly $7,000 per year. And the income they use is from your tax return 2 years ago. Your 65-year-old self is being charged based on what your 63-year-old self earned. If you retired between those years and your income dropped, you can file Form SSA 44 to get the surcharge removed. Most people pay it for years without knowing they can appeal. Number 9. The IRS treats your home sale differently after 65, but the rule is the same as it was before. You can exclude up to $250,000 of capital gains on the sale of your primary home if you are single, or $500,000 if you are married filing jointly, as long as you lived in the home for at least 2 of the last 5 years. This rule does not change at 65. But the reason it matters is that many seniors are afraid to sell their home because they think they will owe a massive tax bill on the appreciation. A couple who bought their home for $100,000 and it is now worth $500,000 has a gain of $400,000. As a married couple, they can exclude the entire amount. Their federal tax on that sale is 0. The fear of a tax bill that does not exist keeps people trapped in homes that are too big, too expensive, and too much work to maintain. Number 10. The IRS gives you 1 more year than you think. Here is something almost nobody knows. The IRS considers you to be 65 on the day before your 65th birthday. That means if your birthday is January 1st of 2027, the IRS treats you as 65 for the entire 2026 tax year. You get the extra standard deduction, the senior bonus deduction, and every other age-related benefit for a full year earlier than you expected. One day can mean thousands of dollars in tax savings. Check your birth date against the IRS rules, because you might already qualify for benefits you thought were a year away. Every one of these 10 things happens automatically on the IRS side, but none of the benefits are applied automatically on yours. The deductions do not appear unless you claim them. The withholding does not stop unless you file the form. The Medicare surcharge does not get removed unless you appeal it. The conversion window does not stay open forever. The IRS changes how it treats you the moment you turn 65. Whether those changes cost you money or save you money depends entirely on whether you know they happened. I will put all the form numbers and links in the description below. Send this to someone who is turning 65 or who already passed it without knowing any of this. A spouse, a sibling, a friend. Because the IRS is not going to call them and explain what changed. That is what this video is for. I will see you in the next one.